going to be short anyway. I got
That's
stuff.
okay, but they love
All right. So here, 5 hours ago, Reuters carried a story. Germany's Schwabel calls on Lagarde to respect ECB's limited mandate. So Schwabel got the nuance of Lagarde's speech and pushed back because he says, I'm quoting, but the mandate of the ECB is limited because an independent central bank is only justifiable in democratic terms when it has only a limited mandate. That's Schwabel pushing back. So this is really going to play out, I think. Honestly, everything Santelli and I have discussed, and in this room, but more with Santelli, in the way that I've viewed what's coming, and the role that Lagarde is going to play out here. The question, of course, as we're always going to go to, right? How are we going to make money? And that's all I care about. And so when I look okay, now we've talked about steepening curves quite a bit, even before. So interesting how much the Canadian curve has moved, because the Canadian curve was at negative 21 not long ago. Today it's at negative 2.5. That's a pretty quick move. And we have the 210 US is 23.3, and that was when we were talking Wednesday. I don't think we've talked since then, right? That was the prep day, the prep before the Fed meeting. I think the curve was trading 17.5. I think it traded down to 14 during the press conference when it looked like, and it was rolling back. And now we're back to we're making highs actually for quite a bit of period at 23.3. That's pretty much current. So you're getting steepening. The German curve is is steepening from where it was. Everybody else, everything is moving. France is already out to 57. So everything's kind of moved about the same. And again, why would you? My question still remains, and it goes to Rick Reeder, anybody who's a big bond portfolio manager. Why would you be buying duration here when I can get basically the same yield without the? Yes, I know, and that's what Faber brings to the discussion, and it's interesting hearing it from him. That kind of caught me by surprise, but he's really seen the world. He's really seeing the world through a deflationary mindset. And I wanted to really go with him a little bit more with that, but it didn't, because the language gets a little funky. So I think that's made it a little problematic. But I don't see that. But I did get a little chance to push back on him. I'm going to post it tonight in tonight's blog. As soon as I finish with you guys, I'm going to write up a short one and post both those, because I thought the Jimmy Bianco one was really good too. But that covered, Pax, you must have been laughing because I was walking out when you were getting ready. But it covered everything that we discussed in that room, and
it was great.
So nice and clear. But the key is everybody sitting in this room knows to be prepped, because if you're prepped, you know what's happening around you. You could see it. You can really see it. And as I said, I know Anthony was kind of funny, but if you draw up a plan and you know who you're playing against, it's like coaching against Woody Hayes with John Brockington. Go ahead, give him the ball. I know where it's coming. Can we react to it and make it work for us? That's all. And that's what we try to do. So those charts were very, very, very good. I thought that turned out to be a very good thing. But that was also something to get that posted out too. Anthony did a really good job, and Jimmy Bianco is just really wonderful. Him and Bookfire, really, if you get access to them, and they're both really good because they have a sensibility of the markets. And not everybody who's out there talking truly has a sensibility of the markets, and I think that's what makes them.
Well, I mean, Ira, Gary Schilling doesn't think the global deflationary forces have run their course yet either.
I know. He's been on this for a long time. People who are big fans, and listen, again, I can respectfully disagree. Just like with David Rosenberg, I can respectfully do, but it's very respectful, and it's a real therefore it's a real conversation rather than just yelling at each other and over each other. So my sense is, and it's been my sense for more decades than I care to discuss, and Bernanke really brought it to the fore, central banks fear deflation more than they fear inflation. Now, my last blog was about the symmetrical 2% inflation. Okay, then there's pieces out there about it today. There's a piece from, somebody wrote about it from the Fed, I believe. I'm not even sure how to, again, how do you measure this? What is he talking about? Is it a time thing? I'm in a room with a lot of technicians who understand stochastics and time measurements. If they've relegated, which I believe they have, inflation to a stochastic time measurement, then again, I posed a question. Will they allow inflation to run hotter than 2% for the same duration that it's run under 2%? That is
a safe bet. It's a safe bet. They don't know themselves.
No, they don't. And he really did not define it. He leaves it open-ended with that nice phrase of material reassessment. We are just left with this, and it's that uncertainty. And I know I see what the markets have done today. Unfortunately, I tried to reestablish my silver too early. I was really out so well and just jumped a little bit too much. But I'm watching the gold-silver ratio is really getting interesting to me, because here's a day where the silver got hammered, but yet the ratio still kind of held in here where we would have seen a bump. So I'm paying attention to it. I will just trade it. I'm not married again to anything here, but it is worth watching. But I disagree with Schilling. I think that the banks will err, and and it's hard to disagree with him because this is his life's work. But he believes that once deflationary forces set in, that you basically can't stop them.
Well, Japan saw that, right?
Yeah, it's the expectation that the widget that I want to buy today, I can get it cheaper tomorrow.
Right, which is what, this is what Keynes and Schumpeter, I hate to get pedantic here, but, I have to give it to you in the way that I know it. It's not to show you how much I know, but these are the sources. And if you really, if we're going to have real conversation, sources are important. I don't just, I could be Jim Cramer and just throw crap out there, but that's not going to help anybody. But the whole concept, in fact, I was doing some work last night and I meant to go to it. But, everybody uses that phrase, pushing on a string, which is really the penultimate outcome, is what you get from a deflationary setting in. And that's what, Schumpeter was the one. That's why I read it, in all my research in his diaries, when he diaried the Great Depression, and he talked about this, and I think he's such a great economist. But everybody throws it around, pushing on a string. What it means, okay? I can't explain it to you better than this. Pax has an idea for a business. He wants to build a business. So he's going to borrow $100,000 at 1%. But if the economy is in such a state like 08, 09, where everybody's worried, or what Richard Koo called, the balance sheet recession, if you already owe money and you're looking to pay money back, you're not looking to expand the business. So no matter how good your idea is, you say, well, I can't, nobody's going to be buying this. Nobody's spending anything. Everybody is battening down the hatches. So I can lend you $100,000 at 1%, But if you don't feel you can generate a 2 or 3% return, you're going to say, no, I don't want that money. If you don't feel you can generate a return at all, no. So no matter how low I take rates, lending rates, if you can't, you as an entrepreneur, because this is all part of it. This is the way it works. Because that's the actor here, the entrepreneur. When can you get that entrepreneur to borrow money to engage in starting a new business? And Schumpeter had always said, even if money's free, and if you can't generate a return, you're not going to start a business. So that's truly the concept of pushing on a string.
Ira, that's the point that the political elites don't understand about CapEx spending, okay? It's what you just described. They're not going to build plant and equipment or spend money on plant and equipment when the demand for their widgets just isn't there.
Exactly. And you know what? Matt? It's a very good point because, see, that's where we're at. And everybody goes, where's the CapEx spending? I mean, you must have heard it on CNBC and Bloomberg 30 times a day. CapEx spending isn't there. But if you're living in these times of uncertainty, tariffs, political elections, again, if it's uncertain times and you go, I'm not going to commit, you know what? Let me tell you what, as the polls get closer next year and you're worried, and if somebody who is not palatable to the entrepreneurs and capitalists of the world, they're not going to be spending. And you know what? And I let's think about this. And I'm going to throw this out there, and you may as well tattoo it on your arm, because everybody's talking about Trump has to have a levitated stock market, right? If he runs, right? Stock market, again, 9 out of every 10 people I know who have any kind of money and who actually invest, they'll tell you, oh, he's got to have, stock market has to be up for him to win. But let me ask you this. What if he's running against the person that they're poking at the hardest, and the markets start to get nervous, and the markets ahead of the elections, as the polls shift and the market starts to drop 15, 18, 20%. So is that feedback loop a self-fulfilling prophecy that buries Trump?
Oh, that's interesting.
Yeah,
do you understand where I'm going here?
Yes.
Because that would be Elizabeth Warren.
Yeah,
well, I mean, we could attach a few names to it, but from what these guys are saying, if everybody starts to get nervous because the polls are within the margin of error, so then it becomes a self-fulfilling prophecy.
Yeah, they just start selling ahead of the fact just because they want to take their money.
Exactly. So then it becomes reality. Then you're not getting it.
Boy,
so
that's interesting.
These are just things to think about. And, because everybody is in this, it doesn't matter. I'm trading the bull side because that's where the market wants to go. And again, we already have the rate cut. The long end is not where in fact, the Fed tells you what they're busy. They involve this QE, QE, non-QE is all front loaded, right? Within, the repo system and short-term money. So that's where they're playing. And if those people start rising in the polls, believe me, the debt markets will not be a safe haven. The short end will, but the long end won't be, because why should I buy if I'm worried about this for the system? Aren't bonds just as vulnerable? Because we know what their mechanism for spend, is to produce as much liquidity as possible. So this is really fraught with a lot of things that you should get a whiteboard in that room and just start to write some of these down, as I have to think about them too, because these are real issues, and everybody thinks this is so simple. It's binary. Trump market has to go up. Well, maybe not. You know what? And again, okay, every day with the Chinese and the U.S., there's a lot of to and fro. Yes, they may have a deal done. And at least the short, again, we're slicing salami, so they found a piece of salami that they like. They cut that off. They're not going to give you everything because, again, is it in his interest? Is it in Trump's interest to deliver everything at once?
Well, look what's happening right now, Ira, as the bonds have had a huge break today, and now all the banks are selling off.
Oh, is that right? I didn't
all
really.
the banks are selling off right now. And when I keep looking at the board, the spreads have really lagged this whole move in the indices. So how does that spread get to new highs? And I keep thinking it's the long end of the curve coming down into the 153s in the 30-year, back to the weekly and monthly averages.
And again, the bonds were, of course, under pressure again. And looking at, so yes, Judd, that is in fact right. But here's what I posit, and you put this on the whiteboard too. Is it the long end that really matters? I say no, because I will tell you this: steepening curves in the short term are a tendency to be bullish for equity markets and for hard commodity assets too. By the way, because they reflect a fear of increased growth with the central bank being on hold. So why do I want to? Now I worry have an inflation fear, so I'd rather be in the front end than in the long end. And so this is, and if that's the case, of course it's just beginning. The 210 at 23 is still historically flat. It's not totally flat. We were inverted not long ago. As everybody's quoting the 3-month 10-year, has moved. Santiago, it's moved 80 basis points, I think, which is, again, because the Fed's involved on the front end, so it's doing what it wanted. I actually I got out of all my 2.5s today because I got hurt with the silver, and I did the idiot traders. I just cleared the decks until I reassert. But I'm going to come back and look at that 2.5 because, again, I think there's as much there. If I can get that today, it's at 2.5 or so. So if I can get it out to positive 20 and a half, it would be a very nice move. But it's been there. It's been there for the day, and it's all been curves because the two really hasn't moved.
Yeah, and and the gold. I still like this gold down here. They came all the way down to the bottom of that point and figure on the 100 at 1480, and
yes. Absolutely right. And I'll give you another one working off of last Wednesday's work. We are closing above the lows that was made at 1483.20 in that first 10 minutes of the press conference.
Right. And all the short-term stuff, and even the 240-minute looks like it's trying to bottom right now.
Yeah, 14.8. So that was 1483.20. The silver went through their low, but is back above that. I think that low was 58.5. So we're holding at some interesting levels. Look you could see the gold totally reacted to the interest rates today, and the long end, not the short end. The twos has been there all day. When I woke up this morning, the 2-year futures, Treasury futures were down a tick and a half. I think that's where they're still sitting.
Yeah, down 2 ticks, and the silver got the weekly ORL stops.
Yeah, but it went. You'll see it went with the long end of the curve because that's the way the algorithms are set up. So we know that that's the trading mechanism. Okay, nothing I can do about it. I'm going to sit here and look for these opportunities because if I'm right, historically I have been right, but maybe this time is the time that it won't be. But let's see what happens. And when I say that. Some of these commodity charts are looking. I've been watching because somebody I know is a really good technician watches it. But the Bloomberg Commodity Index. I don't look. Let's see, GSC. I haven't looked at that in a while. Oops.
Yeah, that Greenhaven one's up. That's taken off. That put in that bottom 2 days ago.
Yeah, and why? Well, so everybody is afraid of deflation, but it seems that since the Fed has done what it's done, the Bank of Japan keeps jawboning. I don't know what the hell's wrong with Kuroda. He needs to say a lot less. It's not like they're in such a wonderful situation. We know what's going on at the ECB, and a lot of people expect, if I read it one more time about Lagarde will be, Draghi is actually Lagarde light. That's what some people think. I don't believe it. I think that Lagarde may negotiate that away. I think that maybe have been what the last cut was about. And I believe that is that Draghi gave her some negotiating room. But we'll see. Nothing is going to be as easy as the spinmeisters in the media, both print, television, wherever you're. They like to make it easy. It's just not going to be that easy. It's not. There's so much stuff going on. So much. And you know what? And you got Donald. And Donald's all over the place. You don't know what you're going to get. But
hopefully more volatility.
Well, yeah, you're getting, but not all of it is, good volatility, especially when you're fundamentally driven and they come at you and then all of a sudden it just reasserts itself. But it is interesting how much of this is being driven on the long end of the curve, but that's the way the algorithm, and that's the way they're built, and that's the way they're performing. Okay, I'm all over it. That's good. I just have to adjust until it starts to break away, and it's other things. But I've been watching too. I've been watching the peso with the 200. There are a lot of things play in here, in lands that they haven't played in. With not necessarily other good stuff around it, but the peso's above the 200. I'm talking about peso's above. Certainly, the ruble, which I have just loved, and I got Faber out on that, so I was glad to get him out on that. We got a lot done on China, so it was really a good 55-minute discussion with him. So where he really presents himself, and again, this concept of the deflation is, and listen, these are people I have great respect for, Schilling and certainly Marc Faber, and I would put Felix Zulauf, and these are. The Druckenmiller, these are really great thinkers. I haven't heard much from Druckenmiller lately. I know all of a sudden, look who showed up. Oh, actually, he had a pretty good line. I don't know if you saw the Gunlach interview from last week. Anybody see that?
No.
Okay. Let me just give you the last part of the interview, the last line of the interview, because I thought it was really good.
I've been just focused on this 200 week in the ruble. Ira,
yeah.
Going there because they ought to really flip the RSX in the afterburners. So
Zero Hedge ran the Gunlach article, the Gunlach it's an interview. It's on Bloomberg, I guess. Let's see, is that right? I don't know. Let's see if that's what they say. No, it was authored by Martin Luscher via Finanz in the Wirtschaft, so it came from Germany. And here's what he says at the end, which I found very interesting. This is the last question is this. Oh, so he asked, it's a two-part. Will we ever go back to normal monetary policy? And he says, no. We're going to have a new normal long-term policy. It's going to be different. We have to figure it out. Look, in 1970, there were no credit cards. This is really interesting because I believe it. It's interesting because I believe it. In 1970, there were no car loans. That's wrong. There were car loans. Trust me. They just operated differently, and they were 3-year loans, not 7-year loans, if you could get that. People saved money and bought things. That was normal. The debt-to-GDP ratio was stable. Economic growth was real. It really happened. And then the interviewer says, and today? Now, this is a very interesting comment. In 2018, the dollar growth of nominal GDP was less than the dollar growth of the national debt. That means there is no growth. We're having an illusion of growth. It means that we're issuing IOUs and spending it. and it shows up in the calculations as growth. But spending is not growth. So that answers, in its totality, Pax's question. Right?
Mm-hmm. But doesn't that take us back all the way back to 2009 from the lows of March? Isn't that the shell game that we've been playing since then?
Well, you've had growth, but and there has been years where you have, and but there's been a lot of debt as we've seen. Actually, in the first years, don't forget people were paying down debt. So when you did start to grow, that was real growth. But as you keep pushing at, where's the CapEx? But if that's what you see, what Gunlott's laid out there, that's the consummate idea of why am I going to take this on? There's not enough growth, so why am I going to borrow money? Oh, rates are 50 basis. Oh, rates are negative? And there are people, you get paid like in certain places in Europe to borrow money, and people still aren't borrowing.
Yeah.
So, you have to be able to see a return. And again, so now you have the uncertainty of Trump's tariffs, which we're not done with, by the way. And he's trying to soft pedal. Well, it seems like he's come to an agreement with the Japanese, and the Europeans are working hard at this. Macron is trying to salvage, and they're not trying to be very antagonistic. The antagonism from Europe towards Trump has certainly died down. They're not looking to poke him because you know what? They don't want to be sidelined. It's like Macron's in China with Xi because he went to that conference. So he's actually in China, and they're pissed that the Chinese aren't paying much attention to the Europeans. They can't get anything done, and Macron is trying to get the focus of Chinese back to Europe so they can do some deals there, and they're perturbed. And Macron, of course, is pushing for big agricultural deals. I guess he signed a couple with Xi today, but they don't want to poke at him. They don't want to poke at Trump because Trump's ability to raise the level of antagonism, and you got to deal with the United States, so it sends everybody scurrying, as we see, as we feel the ebb and flow of on a daily basis. So interesting stuff. This is where we sit, and I think it's very interesting. But I believe the Fed is done because as I've written and I said that day before he even spoke. Okay, he cuts, and and if you got the whiteboard out, I'm gonna posit this because he's cut already. But again, we're sit here and we have to figure out what symmetric 2% inflation means, because if it's what the inference from some is, because it's not defined well, in fact, not defined at all as far as I'm concerned. And I really discussed this with Jimmy Bianco, and Jimmy really is very good with this. And he said, no, it's not defined. Peter Bookfire said too, nobody knows what it means. But if it means a stochastic sense of timing and you'll smooth it out over time, well, now we're in a whole new ballgame. Because if the Fed's mandate is inflation, we know that they're not moving because of employment, right? We know that. Mm-hmm. They've told us that. And they haven't moved. They did, but they took those back, and we've watched them kind of sit here. So that's not going to get them off. And if they're kind of frozen here with inflation because they're going to let inflation run hotter than they previously told us they would, well, then how long are we sitting here? And then if we're sitting here and yet the economy does I'm not going to say the economy heats up, but certain aspects of the economy heats up, the dollar starts going down, so that gets some other things going. Well, tell me where you want to go. You certainly won't want to buy the long end of the curve. I know that, if this is what plays out.
Right. Yeah, and I kind of agree with you. I think those spreads have to catch up, and I think they're going to catch up from the long end of the curve.
And I'll say it again. Trump controls the Fed. And Jay Powell told me that because when he said I took out we had 3 insurance cuts. Well, they were an insurance cut against the uncertainty, using his words, the uncertainty of trade frictions, of tariffs, or whatever we want to call them this week. Currency, they were. So if I'm Trump, anytime I want to badger, I don't just have to just yell at him, but if I start ramping up some type of trade friction, I know that I can. I am definitely the tail that wags that dog, because they're afraid of it.
Ira, let's. I just want to drill on that a little bit. Federal government borrows money that they don't have, so they issue debt. They take in the proceeds from the debt, and the government does what? They spend it, and does not that cash work its way into the economy, i.e. the money supply? So with that process in place, and the federal government continuing to deficit spend, right? What was it, almost $1 trillion this year, right? And it doesn't look like it's going to abate anytime soon. So when I stop and think about this freshly minted cash that is being recycled and working its way back into the economy, what gives on the inflation front? Why is it that all of this cash working its way into the system and into the economy via the federal government's borrowings, why can't the Fed get their inflation target to 2 or higher? Okay.
Well, wait a minute. What did Credelli ask? Bianco.
I'm not trying to imply anything. I'm just saying.
I don't know.
When the Fed borrows, the money does they do spend it, right? I mean, it goes into people's pockets and
not
they spend
necessarily.
it.
Well, it wasn't, which is that's what the hue and cry is, because again, anybody who's a monetary theorist, okay, they deal with the classic formulas and of course the velocity of money. But once the Fed embarked on interest on excess reserves, which don't forget only comes about, at the commencement of the great financial crisis. Up until then, the Fed had never paid interest on excess reserves.
All right, but that's $4 trillion.
Yeah, but you're
not
dealing
not 20.
But that's a global, and is it going on everywhere?
I realize it's a global thing, but it's still 20 trillion over time that the U.S. government took in and spent.
Or there's don't forget there was a lot of
bond sales, right? From bond sales.
There was a lot of wealth destruction. Don't forget that. All those.
All right, that's true.
All those foreclosures. There was massive amounts of wealth destruction. Homes sold
and write-offs.
Yeah, somebody was eating it.
Yeah, here. There's a couple other questions in here. I'll just read them off.
Yeah.
J.P. Morgan is a stat where the bottom 90% of the population spends 101% of their income, and the top 10% spends 70% of their income. Meaning, when the Fed cuts, it doesn't stimulate the top 10% to spend money, is they already have room to spend excess cash, but they don't. And the bottom 90% don't have any extra cash to spend.
Which we do know, right? Because we certainly have seen that effect. And listen, Donald Trump got elected. There's a reason that he got elected. Say what you will, but somebody was unhappy. And I just took a look at a map showing the economic growth of the 5 key states that Trump won in 2016.
Yeah.
And they're the lowest growth states in the union. Michigan, they're not having. They're at the lowest. In fact, they may even be 0 to negative. I just saw a map of it. I don't know how reliable it is. So I'm just citing you what I saw, but it was right through that region. So.
And you had the bankruptcies up that we were expecting. We talked about. in Iowa and all the farmers.
But, Matt, or whoever asked it, let me ask the question back. Okay, so you've had all this liquidity added, right? Unemployment's at 3.6%. Why are people so angry?
So, Ken, you can unmute yourself and respond.
Absolutely.
You know, that's the question I push back at. Yes, we know this. And, you know, everybody, all the policymakers from Europe to the United States, they all look around. And here, do you know what Lagarde said yesterday? She said this yesterday. Don't worry about savings. More important that you have a job.
Yeah, that was pretty insane.
Yeah, I mean, I'm quoting you. I'm pretty sure that's.
Yeah, you're
Ira, you know, a partial answer to your question. Why are people unhappy? Well, baby boomers haven't saved.
I didn't say unhappy.
Why are they angry?
Or why are they angry? Well, baby boomers aren't really retiring the way we thought they would be because they didn't save as much as they were supposed to. So they're staying in the workforce, right?
Okay. Let me roll that back because I am certainly not the average baby boomer. I've made a very nice living, and I've saved a lot of money. And that's what, you know what? Okay, I saved. That was I could have had it all invested in the stock market, but hey, as everybody who's listening on this conversation knows how much risk we take on a daily basis, that was not the way I was set up. So my retirement was set up buying bonds and saving, and that was, and you know what? Had a hole blown through it. But I'm not the only one. You know, I know enough. I have brothers who are doctors who are older than myself. They're not retiring because they too, you know what? They weren't going to be, from the time they were 50 years and older, that heavily invested in the stock market relative to the rest. So they've had an absolute hole blown through their retirement plans.
Yep.
Absolute hole. And they're not the only. You know, the Fed, when this would be posed to Bernanke, he wouldn't even consider it. You know, they couldn't accept that at all, saying that, hey, well, I'll give you what the response was. He had a real response. He told people like me to stop complaining. Don't worry. And they would answer it. And you know what? Mario Draghi picked it up too. So they all had the same response. Stop complaining about your savings. Hey, Lagarde said it yesterday. Stop complaining. Your grandchildren have a job. Your children have a job. Your house values have finally held, and your stocks are going up, and your neighbor has a job. So stop complaining. That's what they said. Yellen must have said that 5 times. I was offended because I thought it was a kindergarten teacher talking to me. That's the tone it was set in. But you know what?
The problem is,
that has
Lagarde,
ramifications too. And there are a lot of people.
The problem, Ms. Lagarde, is that we don't want to work until we're 93 years old and living on oxygen.
You know, that's right. And people are working longer. I know people who are in their 70s who are absolutely not retiring. They can't retire. They could if they want to live a meager existence. But they started eating into their savings faster than they had planned to. You know, because let's face it, you know, if you've had a nice, you know, a decent job, you've worked, and let's say that you have an IRA or a SEP account that has $1 million in it. That's, you know, that's somebody who's been, you know, who hasn't, you know, bought a new car every 2 years, who hasn't, you know, who's saved. And now all of a sudden, that account has gone from earning $60,000 to earning $10,000, $12,000. Well, that's a considerable downswing. Now, I'm not complaining about this. This is just a reality, and it affects economic policy far more than there will, because then that would make them culpable. But again, when you delve into political economy, break it up into 2 parts. The economic aspect of it is the creation of GDP. The political aspect is the distribution. And if you look at it through those two elements, you get a better handle. So when you're talking about creation, okay, fine, but it's the distribution. And when you push interest rates down to zero to bail out debtors, which is what you've done, which is the whole concept of sustaining inflation. Because, we know that inflation bails out people in debt, whereas deflation rewards people who have bonds and everything else. So it's always a real policy. And make no mistake about it. What the Fed did was a policy to bail out debtors at the expense of savers. It's the same thing going on in Europe. And when the Germans we've talked about this I've talked about this for sure 8-9 years in my blog. That's what the Germans have been upset about, is that they've borne the brunt. Yes, and as everybody will remind them, but you had a weak euro in which to build upon. That's true. But not everybody got rewarded equally for that, but they've all borne the brunt of negative interest rates. And in an economy built on the back of savers, which the Germans are, and have been for many decades, there are negative ramifications. And that's what we're going to be dealing with. I can't tell you today, tomorrow, nobody can. But these are the things that the world is going to face. And when Lagarde, I'm looking for that comment, I can't, let's see, maybe I can find it. When it has been done, as Carmen Reinhardt so beautifully, she has many papers written about this. You can go, and they're easy to read. She writes beautifully. You can go Google them. But she writes about financial repression. That's what she's talking about. It's not the first time. They did this after World War II. Inflation after World War II in the United States, 9, 10, 11%. But because they had so much debt to pay back because of the war, they kept interest rates low by design. So that means that anybody with savings got punished, and anybody, especially the government, with massive amounts of debt, got rewarded. So don't forget, that's a policy response. And you can agree with it, disagree, but that's the policy response. And that's what we're dealing with and sorting out and finding where the tentacles of that response are going to go, and how the markets are going to try to sort them out when those policies get aged and a little crusty, and it's time to roll them in like they're talking now, right? Negative rates. Sweden has just said it doesn't work, so they're going to do away with it. They're going to correct it and they're not the only ones who proclaim. The Germans are all over this, and now everybody's beating up the Germans. Okay, got it. So, but the policy fallout is what we're interested in, because that's going to reveal what are going to be possible trading situations. And again, I don't care, but you're not go sit on on Sunday morning talk shows with gibberish and jabber. We're interested in finding ways to make it into a profitable, by doing our work and being prepared for it, being able to do it profitably.
Yeah, here Lars is already saying pension funds are already complaining, having problems because of the zero NERP. Additionally, state pensions are usually way higher than normal worker pensions. Even mass media is starting to pick up on this in Germany.
Oh yeah, and people don't like, the FT, either today or tomorrow. It may be in tomorrow's. I just read it. They had the editor. I can't stand the editorial board because they're so. But here, I'll read you ours is dead right. Here's what they say. It's the title of their Let's see. I know I read it. Let's see. Now Dalio's out talking a bunch. Everybody's talking. Come on. I'm looking for it while I talk. But it was. They have an editorial. It may have been today's, and maybe tomorrow's. These just came out 2 hours ago. In the FT, Germany gloom is top economist / growth forecast. We need to admit that the euro was a mistake. That's the Hungarians. Let's see. I know. I'll find you this. Come on. Where's that editorial? Come on, Dalio, tackle inequality or face a violent revolution. You know, Ray Dalio needs to go quiet for a while. And I'm a big Ray Dalio fan, but opinion. Let's see if it's there. Come on. Here it is. It's Brexit is a warning to Germany's ECB bashers. Okay, that's the title. It came out 11 hours ago. I just read it though. It's online, but you know they go after, especially Germany. They're hopeful that the Germans, but they're beating up Germany and everybody now. And this is all, by the way, this is very orchestrated. Because this is why Lagarde is there. And so now the pressure builds. And it's global. Don't forget the United States. We had Mnuchin and Navarro and Trump himself beating up the Germans not long ago, talking about how they need to spend more. So it is a systematic approach to try to get the Germans, because they know once they get the Germans to break as far as any type of fiscal rectitude or stinginess, whatever way you want to call it, everybody else goes. It's like defense spending in the United States. Once you get defense spending pushed through, everything else is available. So they are going, and already Schweible pushed back today after yesterday's. Okay, so here's the last. Then I'm going to go. So much the rest of Germany's political, economic, and business community. In a welcome sign, Berlin has nominated Isabel Schneibel to fill a vacancy on the ECB's executive board. A highly competent economist, Ms. Schneibel has again proved her ability to hit back at delegitimizing rhetoric against the central bank. Continuing to do so at home once she joins the ECB will be one of the most important contributions she could make. Germany and the euro will benefit if her compatriots follow her lead. So we know where we sit. Do we know the outcomes? No. But we know that they are going to have significant impacts. And I will tell you this, as we know, the impacts are going to be felt through all types of things, through metals, we just don't know the way this will all break here. Is there a possibility that Germany says no to it all? Don't know. Still have to answer the question that I still pose, and I didn't pose it to Faber. I should have. Is the German guarantee of the ECB an act of fiscal stimulus? It's a very important question because it'll silence the Lagardes and others, who are trying to pile on Germany to get them to embark upon massive fiscal stimulus.
Can you repeat the question again, Ira?
Is the implied guarantee of the ECB balance sheet, and when I say implied, it's implied by the market, because why else would you lend Italy money at 90 basis points or 100 basis points? You believe that there is a real guarantee standing behind the ECB when they buy those sovereign bonds, and of course the implied guarantee is Germany. Mm-hmm. So Is that actually an act of fiscal stimulus on its own? Is Germany doing its fiscal part by underwriting that balance sheet? Because when I say a fiscal point, because all fiscal is really in a democratic society, is the voters voting to take on, have the state take on liabilities and standing behind it, right? It's what we do in the United States. The debt of the United States is only as good as the people who stand behind it, which are its citizens. Because if the citizens said no tomorrow, tell me what the dollar would be. Tell me what U.S. Treasuries would be yielding. Just a printing press? I hardly doubt it.
Ira, would you say it's a safe bet from this moment forward to assume that solutions and outcomes won't make any sense, at least to this group?
Oh, I don't know. That's a big question. I can't answer that. I don't know. That's what we're going to be watching for.
Okay, guys. So that we're going to give Ira a break here because everybody has to go fetch here for their kids.
Yeah. Okay. No, but listen, this room has been really, the pushback and the questions have been really good. And, we've gotten a lot of stuff going on here. This is not, there's a hell of a lot more volatility right underneath our noses and potential volatility even beyond. When I see these VIX numbers and the kind of size it gets sold, we're back in that paradigm of, suppression of volatility. Because there are a lot of fund managers who are going to go with it, suppressing volatility to try to make their last 2 months of the year.
Yeah, and the VIX looks like it wants to go back up to like 1974, the VXX, and then you're going to see what happens if everybody they can keep pushing on that string or they all get blown out.
Yeah. All right, put these up on the whiteboard because we talked about a lot of things, and I don't even remember what we talked about. I know.
We'll have to record it so we won't forget. But the VIX put in an ORH day today. So
what did?
The VIX, the VIX itself and the cash put an ORH day in. So if this thing starts getting above, let's say, 1330, they're going to blow a lot of people out here.
Oh. Yeah, no, and again, that feedback loop, I think, is a very serious question. That I remember. That's the feedback loop that if Warren really starts gaining in the polls, and everybody thinks that Trump needs a strong equity market in order to get reelected, but if the equity market starts turning south because they fear that Warren or Sanders or somebody else that they really fear can win, well, then it becomes a self-fulfilling prophecy. And that's, and again, that goes with, on the day that Trump won, remember Paul Krugman, Nobel laureate in economics, said that the equity market would drop 25%. I still have my bid in.
Yeah, it stopped at limit down though.
Yeah, and then bounced. I know.
It stopped at limit down because of the CME breakers. You're back on the board. Do something about that. No, and I won't even speak to it. I'm gonna tell you what. I love those circuit breakers. I was instrumental when they were first put in 18, 19 years ago, 20 years ago, whatever it was. And you know what? It kept us in a very good situation. Yes, I finished with them.
Yes, it
I'll
did.
tell you what yeah, it did. I you know what? And then some followed, but they made fun of it. But I'd still maintain that was a great thing. It saved reputation and it saved the hell out of Treasury for a lot of people.
I agree.
Because it kept the clearing firm solvent.
Well, but let me tell you this: when you see the way that these algorithms work, and I saw it back in the '90s, and they were not nearly as sophisticated.
Yeah.
But when you could theoretically see that something can go to zero, it could. Well, not zero, but one. I had let her out. But 1 cent, and I'll leave you with this because I saw it. Okay, May 6th, 2010. What was that? Come on.
I was still breathing then. Hold on.
May 6th, 2010, the flash crash.
Oh, yeah, shit. Of course it was.
May 6th. Okay. Now, I'm sitting here, and I'm listening. I have CNBC. I'm sitting in the same spot I'm sitting right now, and Kramer's screaming on the TV. Now, I start looking at stocks that I own. Okay? And I'm talking about quality stocks. I'm talking about a bond fund, FAX. It's an Australian, New Zealand bond fund that at that time was paying about 6.5% on a monthly dividend as they clip coupons. It traded for a penny because, and that's not even a volatile stock, but because of the way the market was structured, there were a lot of stocks, not a few, a lot of stocks that traded to a penny. Now, of course, they went and took them out, and they left the low break, I think, on everything about 40% or 60%. I'm not sure, one or the other. And so I was sitting there calculating that if I could have bought that stock at a penny, because that's as low as it could go. It couldn't go to zero. It could only, by the math, go to 1 penny. And there were a lot of stocks that went to a penny. So that's why you need circuit breakers. Because can you imagine if you had stops that got filled and somebody, who buys them, I don't know. But somebody, it traded as a penny. It had an effective yield. You ready? 6,500%.
Oh, my God.
I did the math. I go, let's see, if I could have bought that at a penny and I'm getting that dividend, it was a 6,500% yield. Of course, they went back and corrected it. See, I think they put in, I'm going to go, now I pique my own interest.
Ira, it doesn't look half bad right now.
Oh, it's I still hold it because it's just one of those things I've held on for forever because for the yield. Believe me, I've owned it for so long. So what was that low? There it is. It's in May. So you see it at 255. I'm on a monthly chart. You see it?
7.7%.
What was that symbol again, so I can put it on?
FAX. It's nothing. It's a boring. It's real. Trust me, it's nothing. So, but you could see in May, and it was May 6th. I'm telling you, trust me on that. $2.55, and that was after they took out all the ticks below that.
Oh, man.
So that's why you can't let these machines just run. I'm sorry, I'm a free market capitalist too, but sometimes you need not sometimes. You need good regulation. If you're going to have regulation, have sensible and good regulation. I believe in that because you're going to have it regardless. But if you don't have good regulation, you think you're going to fool everybody, you are going to wind up with the type of regulation you don't want. So as long as I'm going to be regular, I'm going to have good regulation. And those speed bumps were very important. And again, the New York Stock Exchange had to go back and take out a lot of stocks went to a penny. Boy, Kramer, go back and look at Kramer screaming, yeah, can you believe where that is? That's not possible. What's going on? And that's why it wasn't a fat finger mistake. Everybody was trying to sell it as a fat finger mistake. There's no way, because you had things that weren't even in indexes that went to a penny. And you know what? I have yet to hear an explanation of what happened on that day.
Yeah, they never did come out with the real answer, have they?
Nothing official. I've never seen anything official.
Wow, that's an amazing chart.
And I'm telling you, they took it out. And Judd, when they take things out, they take things out.
Oh yeah.
And there were a lot of things like that. So interesting times. That's why, you know what? I know everybody wants it, but I like to, at the end of the day, because if I was long and I got stopped out at a penny, and then it's trading $4, no, I'm not a happy client.
No, of course not. How do you even adjust that?
No, yeah, that's right. And you're talking about a bond fund.
Yeah.
Something, I don't know what went wrong.
Really bizarre. It's a bond fund.
Yeah, it's a bond fund. You know, Australia, New Zealand. I've been in it. Believe me, if it went to zero, my return would probably be diminished to about. I've been in it for so many years, and I've earned so much, so maybe it would relinquish me to about 2 or 3% over the whole period. Okay.
Wow.
It's one of those revenue gainers. It's actually doing better now that the Australians they didn't cut rates this week, thank God. Okay, I think that covers a lot, but I mean, really, put them on a whiteboard and record them, because these are things that I think are really going to be significant as we head into, the late part of this year, and who's going to be fighting, to generate return, especially with the indexes up so much, the primary indexes. A lot of people are going to be struggling because they're going to be massively underperformed. So let's see what, in fact, does take place.
All right. Well, we'll have this out in the morning.
Some interesting stuff. Yeah, thanks, Ira.
Okay. We covered a lot of ground. Okay,
yes,
thanks,
we
Jeff.
did. Thank you.
Thanks, Ira.
Okay.
Are you going to